to ensure the information contained in their financial statements is as accurate as possible. Businesses always have to prepare year-end adjustments. With that, grade 11s, welcome to this lesson. We cannot talk year-end adjustments without bringing up GAAP. GAAP stands for Generally Accepted Accounting Practice. These are some of the rules that accountants follow when they prepare financial statements. They do so in order to achieve uniformity in the manner of preparing these financial statements. Let's look at some of these GAAP principles. The first one we have there is business entity. According to this, all that belongs to the business should be separated from what belongs to the owner. And what belongs to the owner should be separated from what belongs to the business. Let's look at the example there to see how we apply this rule. The owner owes her sister 3,000 for holiday costs. This will not be shown in the financial statements because the owner engaged in this transaction in her personal capacity. Second on the list is what we call historical cost. According to this, the assets we have as a business must be shown in their original cost price. For example, land and buildings are shown in the financial statements as 300,000, even though the market or fair value is 900,000. This is to avoid fraud, as we have seen some companies do. Third on the list is what we call prudence principle. According to this, financial results are presented in a pessimistic way. Pessimistic meaning you expect to lose something. For example, damages payable to a client will be finalized next year. However, a business records 10,000 as it expects to lose that much. We then have materiality. According to this, the information that is worth a mention to all the important stakeholders must be shown in our records. For example, interest on loan is shown separately in the note to the statement of comprehensive income because we want to know how much of our money goes towards paying interest on loan, for example. We then have the going concern. According to this, when we prepare our financial statements, we do so with the assumption that we will continue to exist in the future or in a foreseeable future. For example, the owner of Bochabela Pty Limited is moving to QwaQwa, but her business will still operate. This means her moving away from Bloemfontein does not prevent the business from existing. The last one is matching principle. According to this, income and expense items must be recorded in the correct reporting period. For example, when a debtor pays his account, the discount given must be recorded at the same time. Let's move to the next slide. Remember, we are still on year-end adjustments. What is to adjust? To adjust means to make something fit perfectly. In accounting terms, it is to ensure that all the amounts that have to be recorded in our books appear. This is to achieve the matching principle. For example, you'll subtract money that was added by a mistake and or adding money that was supposed to be added. Let's look at some of these year-end adjustments. First on the list is depreciation. This is the value by which an asset loses its value due to wear and tear that is being used. We will look at some of these depreciation methods in our subsequent activities. But important to note is a depreciation is an expense, so it will fall under operating expenses when we prepare statement of comprehensive income. Secondly, we have what we call trading stock deficit. Deficit means shortage. So what is this shortage? When the value of stock at the end is less than at the beginning. I'll repeat it. It's when the value of stock at the end of the financial year is less than at the beginning of the financial year. So you'll regard that difference as an expense. So to get your trading stock deficit, you'll subtract the opening balance from the closing balance. Trading stock surplus is when the value of stock at the end is more than at the beginning. So to get your trading stock surplus, you will subtract the opening balance from the closing balance. You will then take that answer to your operating income in the statement of comprehensive income. We move to prepaid expenses. What do we mean by prepaid? You paid before you were expected to. So as such, we regard a prepaid expense as an asset in the statement of financial position. So a prepaid expense is an expense paid in advance. This means it's that expense you paid beyond the current financial period. The extra amount you have paid in advance, you'll record under trade and other receivables, under current assets in your statement of financial position. Let's move to accrued expense. This is the expense you had to pay but you failed to. So let's say you had to pay your creditors or your suppliers for 6 months, but you only paid for 4 months. It means you are behind by 2 months. The amount you are behind by, you'll still have to record in your statement of comprehensive income in order for our records to match. So you'll take that expense in question in the statement of comprehensive income and add to trade and other payables because you owe your suppliers some cash. So you'll record that under current liabilities in the statement of financial position. We have accrued income. This is the opposite of accrued expense. It's an income you expected to receive, but you did not. In the statement of comprehensive income, you'll add to the income in question, for example, commission income or rent income, and also add it to trade and other receivables in the statement of financial position. Moving on to the next slide. We have income received in advance. Sometimes clients may decide to pay you in advance. That is, paying you for the next financial year. And in your income statement, anything that you are not supposed to receive but you did, you'll subtract. So if your clients pay you rent in advance, any extra portion they give you, you will subtract from that income item in question and transfer it to your statement of financial position under current liabilities, specifically under trade and other payables. We then have consumable stores on hand. Pens, rubber strings, pencils, eraser, among others, are what we call consumable stores. Items like this we need in order to run our business smoothly. And any part of it left is what we call consumable stores on hand. The consumable stores on hand, you will minus from the consumable stores figure in your pre-adjustment trial balance and record the answer in your statement of comprehensive income. The part on hand you will add to your inventories in the statement of financial position under current assets. Next in line is what we call bad debts. Bad debts is credit customers who fail to settle their debts. It may be due to financial difficulties, retrenchments, or poor financial management skills. Bad debts you regard as an expense in the statement of comprehensive income. We have provision for bad debts or allowance for credit losses. This is where we apply the prudence principle. Remember what we said about the prudence principle? It's that the business has to make provision for losses. Provision for bad debts or allowance for credit losses is an estimate of debtors you think will default on their payment or not pay. How do you treat this in your financial statements? You first have to determine if you have an income or an expense. Both you record in the statement of comprehensive income. You have an income which you will record in the statement of comprehensive income if the provision for bad debts at the end of the financial year is less than what you have at the beginning of the year. Let me slowly spell this. If the provision for bad debts at the end of the current financial year is less than what you had at the beginning, so this means at the end you have less and at the beginning you had more, meaning you had anticipated to lose more. So you'll record the difference in your operating income in the statement of comprehensive income, because the people who you thought will never pay were less at the end than at the beginning of the year. You then have the part of your provision for bad debts which you record under operating expenses. How do you know this one you record under operating expenses? It's when the amount you have at the end is more than what you had anticipated at the beginning. We will leave it here for today, K11s. I hope I've been of service to you. Until we meet next time. Bye-bye.